A new edition of the Money Markets and New Age Investing Podcast. It's season 3, episode 8, and today might be the most interesting and exciting, at least for me to do it, episode we've done yet. Asking, and not rhetorically, the question, is Bitcoin the new T-bond and gold the new dollar? I have come to believe there is a correlation between Bitcoin and the bond market. The 30-year T-bond getting above 5% in yield coincides, correlates to the price of Bitcoin in the futures market get above $100,000 per coin. So it's straight up. And when you look at the ratio spread, Bitcoin is in a major bull market against the 30-year T-bond price and breaking out to new highs. It's interesting to think about, okay, well, of course, Greg, it's not a bond. Yeah, I get it, all right? It's a little bit tongue-in-cheek, but not that much tongue-in-cheek. Because if you really think about it, what's the bond? It's an IOU. From a country that's insolvent, can't control their spending, is spending twice as much as they earn many, many months out of the year. To the degree where now, debt is $36 trillion, where household debt is $18 trillion, all told is $54 trillion. It's almost double GDP. You can't come back from that. It takes more debt to create growth. You need the growth to support the debt. It's that simple. And when you're in that situation, you want to buy a bond and get paid in another piece of paper that's another IOU. That's the dollar now, an IOU, just like a bond. It's all the same. I promise to pay you back. And what's interesting in that currency that you're going to pay you back in, of course, they're depreciating and debasing and devaluing the purchasing power of that currency every single day. So why not Bitcoin? Safe haven, liquid, in and out, fast, blockchain, you can really, in terms of seeing where it is, in terms of having some degree of safety, and it's not backed by any government. It's not saddled by any debt. At some point, there's limited supply. I kind of like it. I mean, maybe it's too simple. Maybe it's just downright crazy. I don't know. I've been called crazy before. I'll be called crazy again. Crazy is good in my book. When you pick up something that maybe has a sliver of a chance to become the next reality, that's what I learned to do in the big hedge fund that I worked for in New York. Sit around and what if it to death. That's what I do. Find the risk, find a potential reward, what if it to death. And then when you see things start to develop in the way you thought they might, you jump all over, you pounce, you're ready to go. We're ready to go with this today because this, again, you're going to want to get the charts from today's. I put them together special for this. I'm virtually going through them as I speak to you. All right, there was literally 59 charts, 63 pages, a couple of cover pages, and 59 single-page charts. Easy to read, really macro stuff. All the stuff I'm going to talk about right now, you can find a chart in this package I put together for the podcast audience. Email me to get that. Greg Weldon, GregWeldon, Greg Weldon at weldononline.com. Straight up email me. It's yours. Trying to help people. And when you see the charts, I can sit here and throw trillions of dollars and hundreds of billions of dollars, and it doesn't have the same impact when you're looking at a visual that is guttural. It's visceral. It makes you feel exactly what you're seeing, and then you understand this is not sustainable. We're in the debt black hole, and there's implications, and we're about to talk about them. Let's talk about the bond market, which, of course, we have to start with the U.S. budget. I just passed another package on Bloomberg. This is interesting. A Bloomberg article said it's going to increase the debt by $3 billion over a certain period of time. And I thought to myself, this is part of the problem. 3 billion, 3 trillion. These are just numbers. People don't get it as to the magnitude of the math that is involved going forward to have to keep pace to make sure growth doesn't pancake, because then you can't service the debt, and it's a debt deflation, and central banks will fight that every single day of the week. That's why you're going to have higher inflation. That's why we're here talking about the Fed. But in the budget, in the first 7 months of the new fiscal year, all right, ending September, so we got 5 months left. First 7 months, the number 2 expense is interest on the debt. Almost $600 billion, 2/3 as much as Social Security at 907. Higher than healthcare, defense, veterans, and education by far. All right. In that context, and I haven't heard anyone talk about this. All right. But public borrowing, well, of course, most of this debt is financed by borrowing from us. I mean, it's public debt. that then they borrow from us and then they sell it back to us. And we'll talk more about that in a minute, how crazy harebrained scheme that is. All right, but in their public borrowing, they lay out in the budget how much they're going to have to borrow from the public year ahead. So last year was 1.695. This year it's budgeted at 1.9. All right, so first of all, it's a 12.2% increase year over year in borrowing from the public. 12.2%. That's higher than any other statistic. Inflation, growth, retail sales, labor market. Is the public borrowing is double any other real statistic. Number one. Number two, 1.9 billion, excuse me, 1 point, there we go. See, I did it myself. 1.9 trillion, because you can't believe these numbers. We're talking trillions. 1.9 trillion they have to borrow in this 12-month period. Well, the first 7 months, 58% of the time, they borrowed only 28% of the total. In the first 7 months, out of 1.9, they borrowed 550. That leaves 4 trillion. 1.4 trillion in the last 5 months. That's about 270 billion a month, on top of the fact that the Fed is running somewhere, over 50 billion a month in QT. And that doesn't include new debt. That doesn't include rolling over old debt, which is going to be enormous. Wait till we get to those statistics on the debt coming due. This is just new debt that's already been budgeted, is being spent as we speak. So let's talk about the Fed and QT and QE. All right. The QE to March of 2022. All right, that brought the Fed's balance sheet to a total of 8.96 trillion, almost $9 trillion. From February of 2021, that's an increase of 3.4 trillion. All right. Now, you talk about the December the run from QE1 was 1.4. The run through to QE2 and QE3, which ended December 2014, was 1.1. So we're talking about the pandemic was about 3.5 times anything we've ever seen before. All right. Now, the degree to which they have drawn down their balance sheet, all right, it is down by 1.2 trillion. All right. And the last number on a rolling 12-month basis is minus 610, around 50 billion a month. So you throw that with the 270 in public borrowing, that's 320 billion right there. You got to come up with every month just to keep things even. And that's just, again, not even including, refunding. All right. That's without new debt, or old debt. The balance sheet now at 6.7 trillion. Okay. It's still up over 3 trillion from where it was before the pandemic. So that's 3 trillion. The entire time from 2018 to 2015, QE1, QE2, QE3, TARP, TAP, all of that was less. 3 trillion plus, but still less. All right. And what's interesting about it is if you want to create the same amount, if you can see the sequence of math to have the same impact on the economy, all right, this factors into the next QE has to be 9.4 trillion. And if you want to look at it in the same context of 2008 to 2015 and 3 sets of QE that brought us back from the brink of financial disaster in 2009, you'd have to print $24.1 trillion. You're looking between 10 and $20 trillion will need to be the next QE stimulus package to bail everything out. All right. Well, you say, well, don't worry, we're not going to have to get bailed out, right? Well, if the consumer cocoons, wouldn't that change things? And guess what? You can march people on TV that have a vested interest in the stock market going up in perpetuity all day long. Okay. And they can tell me the consumer is healthy, the consumer is strong. I heard one person use the word robust. It's not anything like that. We're going to get to that in a minute. But in the meantime, let's look at the amount of debt now that this has created, 36.2 trillion. All right. You're up 64.5% since 2019. You're up 14 trillion since the second quarter of 2019. Think about that. You do that again, and again, you're talking about, 20 trillion. 65% of 36 trillion. Figure it out. All right. When we start to talk about where we were in 2007 and then to 2019 and all the changes, it was still less, only 13.1 trillion, the entire creation before that. since 2019, less than 6 years, because it's second quarter, you're up 14.2 trillion, the largest ever in history of any period. And it's only 6 years. All right. And what's interesting about it is now that the quarterly increase now, all right, on an annualized basis has run at over 2 trillion, right? 14 of the last 19 months. 14 of the last 19 months. And I think it's 10 in a row. All right. The only other time it's even been there was the second quarter of 2009. And you have 14 of 19 most recent months are over 2 trillion. The only other time in history was one quarter in 2009. Now, the interest on the debt, of course, 1.11 trillion. It's over a trillion annualized. The pre-pandemic high was the second quarter of 2019 when interest rates were going up at 586. And since the peak in 2007, it's almost tripled the debt, the amount of interest payments. So, and when I look at the charts on this stuff, I mean, it really is mind-blowing. It just is. Now, within the context of what do we have that's coming due? Well, if you look at the Fed's distribution of securities in their balance sheet, right, out to 5 years, the Fed holds $1.5 trillion of securities of 1 to 5 years and holds over $0.5 trillion in stuff inside a year. All right. When you put this all together, the debt that's coming due between now and the end of next March, in the next 12 months, 9.3 trillion of existing debt matures. Think about that. I didn't even do the math. Let's do it real quick. 9.3 divided by 12. We know where we're going with this. 80. Yeah, 77.5 trillion. 775 billion a month. 775 billion a month. Throw on the other 320 we got over here. You're talking $1 trillion a month they're going to have to fund. All right. 3.1 trillion was issued 2 or more years ago. So that is going to be higher interest rates too. So it's going to cost even more. And this is plus you got 1.4 trillion in the next 5 months for public borrowing just to meet what you got to do. These numbers are off the charts. This 9.3 trillion comes from the Peterson Institute, by the way. You want to know any of this? Peter G. Peterson used to be a financier. Remember him from the 80s. I mean, this guy's been doing this forever. He's been doing this as long as I have. He's as archaic as I am. He's as much of a dinosaur as I am. So that's what it tells you. But bottom line is, in the next 5 years, almost $17 trillion in U.S. debt matures. That'll all be done at higher interest rates. It's going to be a nightmare. And the 10-year projected cost in interest cost is $13 trillion. That's more than the entire debt was right up until just prior to the pandemic. A little bit before that. But $13 trillion over the next 10 years just in interest costs. Just in interest costs. 7 quarters in a row, it's been above 200 billion just outright for the quarter. That's why you're at over $1 trillion, on an annualized basis. But here's where it gets even more sticky. Because when you start talking about, again, all this debt, well, the public debt held by the public is 28.9 trillion. Just call it 29 out of the 36 trillion of public debt that the government has borrowed on our behalf from us is then sold back to us. 29 trillion of it. It's 80% of the debt that the government has created in our name, we own. It's like a double whammy. We expect to get paid back on that debt. We're paying ourselves. I mean, when you talk about, okay, that leaves about 7.3 trillion or 20% of the debt. Who's holding that? The Fed holds 4.1 trillion of Treasury securities, almost as much mortgage debt. They got like 2.6 trillion in mortgage debt. But the Fed holds 4.1 trillion in Treasury securities. That leaves about 3.3 trillion. Out of that, the top 4 foreign owners, Japan, China, UK, and Canada, own the bulk of it. So the owners are. The Fed holds about, around 12%. Those 4 countries own 8%. And we own the other 80. The other 80. All right. And the bottom line is they're going to pay you back in a currency that they're debasing the purchasing power of through inflation, because they have to have inflation to be able to pay you back. So, you want to talk about the P scheme. That's the P scheme of all time in human history, never seen before. A debt binge, the level of which we've never seen before, and a currency scheme, the level of which we've never seen before. So when you see these numbers, it's irrefutable. So what this leaves is the 30-year bond, which is pressing on 5%, and it really is a 40-year trend reversal, because we've entered the debt black hole, where even if you just take the public debt, you're talking about 121% of GDP. That means $1.21 in debt to generate $1 in new GDP growth. Right? You throw on the $18 trillion in household debt, 5.1 trillion is consumer debt. You're talking about 186% of GDP, meaning it costs $1.86. You have to create $1.86 in new debt to create $1 of GDP growth. You need GDP growth to pay down the debt, or we go into a debt depression, a la Germany, a la Venezuela, a la Argentina, a la many places. Not only that, but you're kind of looking at this, then all of a sudden, every time the US 30-year gets above 5, Bitcoin's above 100,000. Now, that could be pure coincidence. But when you look at the charts in this package and you see the correlation between Bitcoin and the US 30-year bond yield dating back to the end of 2023, it is very tight, directionally very, very tight. All right. Basically, Bitcoin against the bond as a ratio spread is a very clear-cut bull market, very tight wave pattern, and making a new all-time high. All right. No, it's not a bond. It doesn't pay anything. It doesn't yield. But again, better to hold it than the debt of some insolvent nation who's on a borrowing binge, who sells their debt back to the public and wants to pay us off in debased currency. I mean, come on. All right. I mean, dollars just another paper IOU. You have no debt behind Bitcoin, limited supply at some point, no government. It is almost a hedge against the US Treasury market. But really, the bigger picture now, of course, is the economy and the stock market. And I still think the stock market had a nice rally here. We actually were long for a while. Yeah, we're not always bearish in stocks. We'll be bullish. When the dollar cracks big, stocks will go up a lot. It just won't keep pace. The stocks will go higher. But right now, I think we're into the next wave down because the consumer is imploding. The consumer is imploding. Consumer debt, in terms of consumer credit, is down over the last 5 months. Revolving credit is down over the last 5 months. And not only that, the year-over-year change is now negative on a dollar-for-dollar basis, to the tune of, in terms of revolving credit, it's $42 billion. Check that. That's total consumer credit. Total consumer credit. Over the last 12 months, rolling 12-month change is down $42 billion. The only other times that this has been negative in the pandemic, 2009 global financial crisis, and 1990 recession. All right, and in the pandemic, it wasn't even negative as long as it is now. When we talk about revolving credit, which maintains credit cards, down $16 billion over the last 12 months, down 4 months in a row, negative on a dollar basis. And the only other 2 times it was ever even negative, 2009 global financial crisis, the pandemic, and now that's it. Going all the way back to the 70s. 3 times revolving credit has been in contraction. It is a consumer cocoon, because the only other times this has happened is 2008, 2009 global financial crisis and during the pandemic. And now, does now seem like the global financial crisis? Does now seem like the pandemic? It is the consumer. Wall Street doesn't get it. All these people on TV don't get it. Why? Because they're counting the credit card receipts, and now that's going to be a problem. But within the credit card dynamic, it's amazing to see the number of credit cards, okay, and credit card debt is last at 1.36 trillion. All right, down, like I said, it is down 45 billion. 45 billion on a 12-month rolling basis. All right. But in that context, let me first mention that savings, all right, because now we're drawing savings to spend because credit card use has gone down. I mean, people are having a hard time paying the bills. Savings just dropped in the most recent month. This is April, from 907 billion in savings to 872. It's down 35 billion in a month. That's a massive decline. And it is now relative to, you have 872 billion in savings versus 1.32 trillion in credit card debt. Savings is only 65% of credit card debt. Here's the next big stat. The number of credit cards issued in the last year is up by over 30 million. Check that. That's in 6 months. Up 30 million in the last 6 months. It's now above 600 million credit card accounts exist for the first time ever. It's up 150 million since the pandemic. And going back, that means it was 450, now it's 600. That's a 30% increase in the number of credit card accounts. The number of accounts closed by banks just rose 50 million in the last year, from 150 million to 200 million. So they're closing accounts, they're opening accounts. There's an interesting thing about inquiries that suggests most of the accounts that are open are these mailers that are sent out with pre-approved credit. I can slice this data to even get to that point where the majority of newly opened accounts, and they're in the tens of millions, are by the mail-outs and the pre-approved cards that you send at usury rates of $300 credit, $25 a month. It's 100% interest rate. When you factor in the monthly fee, it's insane. All right. So you say, well, it's just a sign the consumer is really healthy, and the demand is up, right? That's what they'll tell you on TV. Well, then answer me this one. Answer me this, Batman. Here's the riddle. Then why is the delinquency rate on credit cards the second highest in history? Almost 13% are seriously delinquent, 90 days or more. 13%. The only other time it was higher was in 2010, right after the 2008-2009 banking crisis. The only other time. This is higher than 2007. It's higher than 2008. It's higher than all the pre-lead. Auto delinquency rates above 5%. The second highest ever. The only other time, again, 2010. And 2 years ago, it was below 4. Now it's above 5. Student loans are back too, by the way. That's another little dig. But these numbers on delinquencies are telling you the consumer is choking. More than that, the consumer is telling you the consumer is choking. University of Michigan survey. Some people poo-poo the Michigan survey. It is what it is. All these survey, all this data, every data point has some kind of crack in it, or maybe it's not what you think it is. So you have to know what these data points are, and then they use them because you understand exactly what they're telling you. University of Michigan, consumer expectations. Their index is expected to rise in May. It fell. It hit 46.5, the lowest since 1979 and 80 with Paul Volcker. There were 4 months when it was lower than this. But that was 45 years ago. And the last 6 months, this index nominally is down 40%, 39.5%, 40%. All right. The expectations on the consumer, according to the University of Michigan, lower than 87, lower than 1990, lower than 2020, lower than 2008, lower than 2020, lower than 2022. It is the lowest since Paul Volcker was defeating inflation with 20% interest rates. Do we see that now? It's as bad now for the consumer. Inflation expectations, I got to tell you, I've had a lot of respect for Jerome Powell. Tough job. I would never want that job. You can't win. But please, Jerome, stop lying to us in a bald-faced lie that you know is a lie when you tell us inflation expectations remain well anchored. He keeps saying that. It's the old transitory dynamic, and we chided him on that too. This is worse. Because you say it doesn't make it true, Jerome. I know you got to try and maintain confidence. You can't say the opposite, but at least stop lying to us, because inflation expectations are completely unanchored. I did a piece a while ago, and then again recently, and then again just recently, anchors away, to show that consumer inflation expectations are completely and wholly unanchored, not only in the University of Michigan, but also in the New York Fed survey. We just went through that. I mean, when you look at the upside of the dispersion index in the New York Fed survey, there's 6.7% inflation expectation against a possible downside in income of minus 1.7. Think about that person. Again, you're talking about real income being down 8% in some of the Fed surveys. I've said this one before. In the University of Michigan, inflation expectations for 5 years are 4.6. In other words, it's going to be 2 times higher than the Fed's target rate for the next 5 years till 2030. Not only that, this was 3% and below 3% most of the end of last year for like 8 months in a row, and was 3% this January. And now it's 4.6. Of course, tariffs, a lot of this, no doubt, but does that matter? This is what it is. And all of a sudden, you thought tariffs are dead, and now we got a big EU scuff up, and Apple's going to get hit for not producing phones in the U.S. And, think it's over? It's not over. This is beyond ongoing. The 1 year University of Michigan inflation expectation is 7.3. 7.3. At the end of December, it was 3%. The 6 months before that, it was below 3%. And now it's 7.3. Jerome, inflation expectations are wholly unanchored. And let's talk about the inflation numbers. How they've come down. It's been disinflation, but I said that would happen. I said it right here. I called it into the October, November low, and that's where it was, and now it's moving higher. And some of the numbers keep kind of coming down a little bit, but that hides something in the fact that most of it remains energy. And the energy base effect remains very negative, by the way, throughout the year. You need like a 80-cent rally in gasoline just to get even with where you were last year by, June, July, August. So you're looking at more disinflation, deflation from energy. Having said that, 72% of the economy, I think it's 71.8% of the economy is the service sector. Service sector inflation ex energy, which is only 2 components in services or energy. So it's not a big deal. Service inflation, 3.6, rent 4, auto repair 5.6, auto insurance 6.4. These numbers are down, but this is ongoing 6.4. Nursing homes 4.6, hospitals 4.3, water and sewer 4.8, garbage 5.2, daycare 5.4, hair care 3.6. Just got my hair cut. 5.4, pet and veterinarian services 5.3. Okay, how about these ones? Sporting goods admission tickets 9.3%, video game subscriptions, streaming subscriptions up 9.0. Of the 79 components of service sector inflation, 60 of them are above 2%. That's 76% of them. 3/4 are above target. 26 of them, or 1/3, are above 4. 12 of them are above 5%, 5 of them above 6%. You're talking about huge numbers here. Still, in inflation, this is why the consumer's choking. And what's going to happen? Well, the Fed's not going to be hiking rates if inflation goes up. They'll kill the economy. So this is really interesting to me, all of this, and how this plays out in the markets. It plays out again. Yield curve steepening. The short end will remain depressed because, they will acquiesce to higher inflation to protect growth. They have to. They know they do. The debt demands that they do. And in that case, that means a lower dollar, a steeper yield curve, and higher commodity prices. It will stoke inflation. All right. It will also stoke asset price inflation. So stocks too will go up. There'll be a time. I still think there's a C wave down in corrective mode, and then you're going to get this time. I think it's still a step away from the Fed busting this move. Something kind of has to give, but we're on the verge of it, and it could actually be the bond market because the supply right now is kind of overwhelming the demand, and that's about to go up. Mandelbaum on steroids. It's Mandelbaum on steroids. How the supply of treasuries for sale, every week is about to explode. And the yield is pressing new highs at 5% as Bitcoin's at 100,000. Bitcoin's a new bond. Gold's a new dollar. We already see that in terms of the BRICS unit and some of the other things. And just the price of gold. The dollar index divided by gold, which is a great measure of the dollar's purchasing power, it's at a record low. It's at 2.7 cents relative to the 1973 dollar. Think about that. And it's making new lows. The actual dollar index just violated the uptrend line and goes back to 2008. And the entire pattern is ABC correction right to the 50 and 61% retracements going all the way back to 1982 and Paul Volcker and the high in 85 on the Plaza Accord. I have lived all of this. I'm telling you, what's coming next is going to be shock and awe and need to be prepared to take advantage of that. We try and help people do that. I think it's kind of almost a do-it-yourself type of thing now, but it's really tough because most people are underfinanced. We trade the futures markets. We manage money in the futures markets. We give recommendations in trying to replicate that with ETFs and some of the equity index and stuff like this, targeting. Right now, our positions are pretty straightforward. I mean, we're long platinum and palladium because I think they've been laggards and they just broke out. I put out a special on this, and I mean, it was higher within 24 hours. Now, I have some pretty good hedge fund clients, might have even been them that came in and bought the damn thing. But nonetheless, we also own Bitcoin. I just bought back into gold. We had gotten out of gold. I was actually a little bearish on gold for a while. It didn't work out. It was wrong play. Back on the long side here. Short the dollar. Various currencies that I like being long that you can play. Some of them you can play in the ETF. The euro looks very strong here. Just did a piece on the euro. A lot of reasons to like the euro here all of a sudden. And I don't like the euro. And all of a sudden I'm seeing I kind of like the euro. You want to get any and all of this, shoot me an email. I'm happy to give you a trial to our research. Those are the specific recommendations we have every day. We use stop loss levels. We give it to you all. I don't hold back. I give 100% to our clients in this vein. This is why I give this for free. I mean, I'm old enough now that part of my mission statement now is to help people because what's coming next, I feel like I see it. I feel like I've seen the entire evolution of it for the last 40 years. And I think I mentioned this in the last podcast. It's funny because we are raising money right now for accredited investors only. We'll talk about that, on the podcast. But I had a new client that just came in and we had talked on the phone a bunch of times. And the last conversation we had was a long conversation. And I said something along the lines of, look, this is a 40-year in the story making from Paul Volcker all the way down to, the pandemic. And we crossed the macro event horizon line, meaning we're in the black hole where it takes more debt now to create growth than we have to perpetually now do this. And that will debase the dollar and that will drive prices of a lot of things higher, particularly, the precious metals and gold. And, so he says, we've been waiting the whole 40-minute call to say that, haven't? And I said, the time is right. And the people that what I do will become more valuable because we're able to be flexible in and out. It's liquid. I mean, we can manage the risk to the hundreds of %. And I do. I mean, a low risk trader, right? And in that sense, it's kind of my closing line, even though I'm not a salesman, didn't mean it to be. It just was a conversation. And I said, yeah. And it's kind of been, and he goes, you've been waiting 40 minutes to use that line on me, haven't you? I said, no, I've been waiting 40 years to use this line. And that's the line we're using. Hit me up on Twitter, @WeldonLive. Hit me up on YouTube, Gregory_Weldon. Hit up the podcast on Twitter @money_podcast and shoot me an email. I'll send you the 59 slide package that has all of this and then some. It has gold. It has Bitcoin. It has all the ratio spreads. You're going to want to see this stuff. I'm telling you, it's an impressive chart pack. If I don't say so myself, it's worth seeing, putting it out there to help as many people as possible. Feel free to share it. Get the word out, in terms of you'd start to really need to pay attention and be a lot more careful with your investment decisions. That's it for today. See you next time. Thanks for listening.